Hi, everyone, and welcome. Give it a few moments. While we're waiting, as always, say hello and where you're from. If you're a bull or you're a bear, depending on the day, hilarious. We've got everyone here, so thank you so much for joining. We are going to talk about butterflies and condors today. Really excited about that. Got a lot of examples. We'll talk about long butterflies, and short iron condors. And I've got some examples of earnings that I've captured before. So had another example actually as well, because why not? That's what we've all been talking about today all year, been carrying the market. So very, very important to discuss, and why not? All right. So disclaimer, we are going to use some real securities today. It is an example. They're older screenshots. The due diligence has not been done. That is normally done for the daily plays. I'm not in charge of the daily plays, so anything that you see on here, different process. So therefore, information and educational purposes only, not intended to be for legal, tax, or investment planning advice. So let's talk about what we're going to get in today. So number one, we're going to talk about the Greeks. This is session 3 of the 4. We've been talking about the Greeks. That's how we started the first one. The one we talked about last week, we went into the long butterflies and taking directional plays, how to maximize and mitigate. There will be a replay, the positive and negative factors. So we just need to review them really, really quickly. We won't go as in depth, but I'm going to have examples this time of what happens to the Greeks with all of the strategies. So very important to talk about that. We'll talk about straddles and strangles. We haven't talked about in this session, so as in all 4. So I'll just make sure that we've got that first. A long iron butterfly and iron condors are actually extensions of straddles and strangles. So that's why I want to start with that. So then we'll move on to the long iron butterfly. Then we'll go to the short iron condor, and then we'll talk about some best practices, and then there's some examples there as well. And of course, if there's time, some Q&A. All right, so let's do a quick review of the Greeks. I'm sure you've seen this slide before. If you have not, that's okay. We'll go through just a very quick high-level overview of this, and then I'll just tack on the details that are extremely important just for this session. So calls are going to be on the left-hand side, puts are in the right-hand side. The bullish strategies are found on the top, and bearish are on the bottom. The idea of this chart is if you're new to options, mind you, this is an advanced session, but if you are new, or even if we're expanding on the Greeks, it still always helps to go back to this. So if you focus on long calls, everything else is essentially a mirror. So we want to understand long calls really, really well. There is mirrors all the way across that you can utilize with this, and I'm happy to expand on that further if anyone would like. So what we need to know for this session, long options, regardless if it's a call or a put, they're purchased for a premium, which means that we own the execution rights, but that means we are profiting from a sharp movement in our directional bias. We really want it to move quite a bit. We are expecting a movement of some sort. We are speculative. So sharp movement, extremely important there. Because of that, it's purchased for a premium. We want to sell it at the highest price possible. Time decay is something that we do not benefit from. Short options, they're neutral to a slight directional bias. We're not expecting this sharp movement. They're just profitable as long as they stay at or just move slightly directional bias. That's why they're considered neutral to upward or neutral to downward. That's where they get their neutrality, is they don't need to move depending on where you sell your option at in order to be profitable, whereas long options need to move quite a bit to be profitable. Therefore, time decay is positive for short options because as it loses its value, its daily time decay, that works for us because we sold it for upfront premium. We want to buy it at a lower price. That's the gist of that altogether. So any real quick on the Greeks, delta tells us our directional bias. So you notice it's positive for those bullish strategies, negative for the bearish strategies. Theta tells us our daily time decay, how much the option will move or lose its premium as each day goes. So that's negative for long options, regardless if it's a call or a put, positive for short options, regardless if it's a call or a put. Where do they benefit from? Gamma tells us acceleration. Gamma, theta, and vega are all centered around at the money options. Since it's our acceleration movement, it increases the convexity to delta. So therefore, anything that benefits from sharp movement has a positive gamma, which is long options, regardless if it's a call or a put. Vega represents increasing the premium by a 1% point change in implied volatility. If the premium is increasing, so we're expecting an increase in implied volatility, that's going to make the premiums more expensive. Therefore, that's going to be positive for long options because we want more expensive premiums. It's going to be negative for short options because if implied volatility increases, it's going to make it more expensive. We want to buy it back at a lower price. Gamma is considered risk for short options. That's why it's also negative for short options, regardless if it's a call or a put, because if it's an acceleration, well, those strategies profit from neutral to a slight directional movement. So we're happy being in a bicycle or that slow little car, but where we're looking at long options, we want a lot more acceleration. So I will take the Maserati, please. So there's your quick overview of how the Greeks work. We'll expand on that, the importance of it, and the reason why we show this with positive and negative just visually is because when we're structuring multi-leg options, we want to know what positively affects each individual leg or what negatively does. Amplify the positive, mitigate the negative, and you can do that by combining everything together. It helps you choose your expiration, helps you choose your strike price, and also helps you close the strategy. So mitigate everything. It's a wonderful tool just for understanding all together, and a lot of what OptionsPlay is built off of. All right. Everyone good on the Greeks? Give me just emojis. However you're feeling today. Awesome. Thank you for the thumbs up. All right. So very simple. Let's start with our strangles and straddles. Before we do that, just the basics. So this is what I'm talking about with the amplifying and mitigating, right? So long put is bearish. We know that we just needed to overcome the amount that we paid. So example here, buy to open 1XYZ 100 put at 150. We need it to go lower than 150 in order to start gaining some premium. Long call is just the opposite because it's bullish. We need it to go above 150, so above 100, 150, and then we'll start gaining some funds on that. It's going to start being profitable. Let's put these together, and this is what makes up a long straddle. So a long straddle is considered neutral because we're taking something with a positive directional bias, which is the long call, and the negative directional bias, which is the long put. Together, it offsets, and that should make sense because you theoretically are going to profit as long as the underlying moves sharply in either direction, hence the neutrality. Normally, there is a slight directional bias because you're not going to be able to buy the options at the exact strike, meaning the underlying isn't going to be exactly at 100. That's really difficult to do. So there tends to be a very slight directional bias. But what you're doing here is you are magnifying your thetas because you're creating a higher premium. So you have a very, very high premium now. Instead of overcoming 150 with your slight directional bias, you have to overcome $3 on both sides. So we've increased that. That makes theta more negative, but we're magnifying our gamma and we're magnifying our vega. If there's an increase in implied volatility, that's actually going to be much better. And the sharp movement is going to be better for this as well because we don't have a directional bias and we're just adding to our long options here. So this is an example of combining two long strategies to amplify, or it really magnifies theta, gamma, and vega. So it still magnifies the negative, but it mitigates directional exposure. This is a great way of building on this entire strategy. So we started with one leg, now we're turning it into two legs, and we're going to combine it even further. So the long iron butterfly spread. This is where we still have the straddle. That's the base strategy, is what I like to call this. So if you've ever attended our discussions on credit spreads or debit spreads, we always start saying that the long call or the short or one of the individual legs is the strategy driver. That's when we're looking at two-legged option strategies. When we get to 3 and 4, It's normally a two-legged strategy that becomes a strategy driver. And in this case, it is the long straddle is now your base strategy where you'd profit from either direction. And you can also look at this as a bull call spread and a bear put spread put together as well. But what you're doing is you're still keeping your neutrality, but you're shrinking those values that you magnified. That's the intent of it. So we cap our gain potential to make us not have so much of a move. 50 cents was the reduction altogether, but that's the intent of the long iron butterfly spread. You still are expecting a sharp directional move. I didn't update the break evens on this. I apologize. This should say 102.50, and this should be, I'm so sorry about that, but this is 250 in between these two, not 3. We reduced these by 50 cents. So this is 96.50 and this is 102.50. And that's the movement that it's needed. But what that's done is we amplified our theta. It was a little bit too much. So if you still want to do a straddle, the butterfly just caps the gain potential on either side. And it's called a butterfly because this looks like little butterfly wings. That's where that comes from. Not something that's traded all too often. However, this was asked for, so I want to make sure that we describe it, go through it really, really well. We use at the money straddles quite a bit to look at implied moves and then utilize that to actually make more premium selling strategies. And we'll talk about that a little later on, but this is the gist of how those strategies work. It is certainly something to be cognizant of, because if you were playing earnings, for example, or like NVIDIA, we knew NVIDIA was going to move a lot yesterday. And it's possible that some people bought straddles. It was going to move. We could calculate the implied move some way, but what's going to happen is you have super high implied volatility on the options. And what this will do is you'll sell the higher implied volatility, and that's how it reduces the theta here. You still have your positive volatility exposure, but, and we know this is going to shrink, implied volatility always shrinks post earnings because that anticipated move is happening. This is a way to mitigate or cap it caps the gain potential, but it also reduces all of that extrinsic value that's priced into those high volatility moves. It's not traded as much because then it goes through the roof. And if it goes too high, like NVIDIA did, then you could start getting extrinsic value here. So it's not something I would personally recommend doing in the slightest. But if you do trade at the money straddles, this is a way to make the negative factors a little more positive. And that is true with the math. So moving on, let's talk about the long strangle. Again, not traded too often, but it is exactly the same as the long straddle. But instead of straddling the price, you just strangle it. This means that you're not buying the same call or put. You are just having a width in between. So you have a slightly out of the money call, a slightly out of the money put. Since they're slightly out of the money, they're still going to need, they'll be a little bit cheaper. But remember, this is movement that you'll need, and you'll have a directional bias of some sort. It has the same Greeks as the long straddle. Also depends on where you select your strikes. But you need to know this in order to understand the short side and what the good stuff that we're going to get into. Now, I'm going to teach you this, or show you this rather, in a little bit of a different way. So previously when we looked at the straddle, we took the straddle and we just capped our gain potential. Here, I'm going to look at a short put and a short call when we move everything around, right? So when we have a short put, we know that delta is positive because it's a bullish bias. Theta is positive because it's a short option, so therefore it's going to benefit. Gamma and vega are going to be negative because a large movement is not going to be beneficial, and then an increase in implied volatility is not beneficial. So we're getting a credit on both of these for 150 a piece, right? And we want to keep that credit, which means that we do not really, in this case, want any movement whatsoever. Because if the short, or excuse me, the XYZ goes higher, that can make the short call unprofitable, the put will be profitable. Or if it goes lower, then the short put will start being unprofitable, but the short call will be profitable. So this is a very true, you want something to stay exactly where it is type of strategy when we do a short straddle. So a short straddle is the same thing, But instead of expecting a very large directional movement on either direction, we do not want the stock to move at all. It needs to stay right where it is. This also can be a time play too. I've really honestly haven't seen a lot of these traded whatsoever, but same thing, you put them together, you magnify the positive and the negative. The positive is more positive and the negative is more negative, but you're offset because of the positive and negative. Hence the, I don't need this to move. It's a delta neutral strategy right here. Also comes with unlimited risk potential. So in order, and then the short strangle, go through this one real quick and then we'll get into the four legs. This is exactly the same, just like the long straddle. The strangle just means you're strangling the prices rather than putting it at the exact same price. So this, but they have to be out of the money. It can't be inverse, different strategy. So a slightly higher call at 103 and a slightly lower put at 97, we get less of a premium, but now we still have our neutrality, but we've got a little bit of range of movement. We're allowing ourselves a little bit of freedom. That's the intent here. Still have the magnified positive and negatives, but we want a range of movement rather than something staying exactly where it is. Puts probabilities a little more in your favor. So we have to know this to know condors and so forth. So that's why we start with that. So now going into the bull put spread. We know how these work. When we have the bull put spread, we are expecting we're just mitigating our risk, right? So on the short put side, if it were to move lower, we technically have substantial loss potential because we'd be obligated to buy the stock. So the way that we're going to mitigate that is by buying a further out of the money option at a lower price, less valuable. We reduce the credit that we receive. However, we're mitigating the risk. So we'll start offsetting the positive and the negative. And depending on your strike selection, these can adjust. So this is assuming XYZ is at 100. And then bear call spread is exactly the opposite, just as in forms of direction. So if we are selling the 110, that's going to be the more valuable option. It's driving the entire strategy. That's the upfront premium. A short call individually has unlimited risk potential. So if the security was to go to an infinite high price, you would be obligated to buy the stock. So in order to offset that, just like with this bull put spread, we're buying a call that gives us the right to buy something that we probably will not execute upon. But because we own that right, but we have an obligation to sell, the two offset each other. This is a much lower margin requirement because you just need the difference of the spreads. We reduced our premium, but we mitigated our risk, which is helpful from the Greek perspective and our overall portfolio management. So whenever we do a condor, a short iron condor, you're essentially putting those two together. That's the intent of it, is just like a short strangle, we're establishing a range at which we can move, and we're trying to keep as much premium as possible. So this is more beneficial in a trading range because we're saying, okay, for a short put, it's profitable as long as the underlying moves up, right? It stays at 100 or moves higher. A short call is profitable as long as it stays at 110 or moves lower. So that's how we established our trading range, is these are our max profitability points between the spread here, which is $10 altogether. If it moves too high, we're capped at 120 as in our risk. If it moves too low, we are capped at 90 as in our risk. For capping our risk potential, we received a $7 credit altogether, but that's how iron condors work. Can be looked at in multiple ways from an explanation purpose. From explanation wise, it is a short straddle with capped risk in either direction, or you could say it is a bull put spread and a bear call spread put together, because it is all of those things. Just depends on how you look at it. But most beneficial in a range bound type of market, or where you expect the stock to stay in between two prices depending on a movement. And I've got some examples of that where we can talk about it. But range bound means neutral. And I want you to think about that when people place these around earnings, and I'll have a few examples on that and then we can talk in a little more detail if you'd like. So let's talk about iron condors because they are definitely the Tom Sosnoff Tasty Trade preferred method of trading earnings is a short strangle or creating an iron condor to cap your risk. So I'll give you an example of that. They are market neutral. And you should see that because the delta becomes very neutral. So they don't have a directional bias. So when you are looking for trading this type of strategy, you do not want to have in your mind, you might say, this is not overly bullish, this is not overly bearish, because then that could get you into your risk territory, which would put you into your loss territory, which means lower beta stocks tend to be a better fit for this, but there's always a give and take. If you have your lower beta stocks, your stocks that don't move as much, so not your Nvidias, then there is less premium, but you are increasing your probabilities of being profitable. You can certainly do it with those type of stocks, and then I'll give you some tools to help you do that. They are defined risk, which means there's no additional margin requirements. When you have a short put individually or a short call individually, it's about 25% of the exercisable value that ends up being your margin requirement, and they take the higher of either side if you have a short strangle. That's very capital intensive. Whereas if you have a iron condor, if you in your options would even pair like this. So say you were placing this trade at Fidelity and you had a bear call spread, bull put spread on the same security and the strikes were correct, whereas in range bound, then it would be paired as an iron condor, and you'd only have the margin requirement of one spread, not two, because the stock can only go one way. So this actually is less capital intensive because of the way the margin methodology is. And if we're choosing a security, remember, we are looking for a strong support and a strong resistance zone. So that brings me to the market neutral and the range bound. Putting those together, if we're looking at something that moves quite a bit, like our Teslas, our Nvidias, or those technology stocks, if you see a very strong range bound where it's got multiple points, so that support is evident and clear, and that resistance is evident and clear, then perhaps that might be a good contender because now you're putting the probabilities in your favor because of the reiteration of the supply and demand factors that you're seeing from a technical analysis perspective. This is when technical analysis can absolutely be helpful for these types of strategies and picking your strikes. So let's look further. So I want to look at an earnings play for NVIDIA and what happened. And this is an example of the at the money straddle where it was 2 days till expiration because we know NVIDIA reported yesterday. You take the options expire tomorrow, so not today. So that's the closest front month option that we could get to it. So an at the money straddle can actually tell you the implied move. If you hear oftentimes people will say the implied move for earnings is this much, so on and so forth. This is what NVIDIA's was. So NVIDIA, I felt like I had the percent on here, but I must be dreaming right now. So NVIDIA closed yesterday around 674.72. This was the price of the closest at the money options, so 37.15 and 37.05 together. That represented about an 11% move. So thank you, Craig, 11% implied. So that was our 11% implied move. It opened up around that, but soon volatility picked up and it went well above that. So this is an example where it was more directional than being range bound, but that doesn't always happen. So with this type of move, there is a way that we would select our strikes. Unfortunately, I didn't pull those numbers yesterday, but this is an example where it went well beyond the implied move. However, I've got an example of Tesla where it stayed within it and what happened. So we'll go through that. But does this make sense as far as how to plot and understand the implied move of an earnings play? Because if you're going to place these type of trades, would love for you to know how to do that. You just pull the at the money straddle. There are a couple of different ways to do this, and it varies, and I think it's kind of interesting, and Tony and I were actually debating this earlier today. But you would take the price of the at the money straddle and then combine those together divide that number by the last price, and that's how you get the implied move, that 11% move. Some accept it as taking that number and finding the 85%. So that would put this one at about a 9%. I could see that if it's the expiration isn't so close, but I don't think I necessarily agree with that. I think that's more of a conservative approach, and I wouldn't do that with a tech heavy stock. However, if you were to ever look up or Google how to find the implied move of an option strategy, you'll find those two methods. And so I want to make sure that we address them, discuss them, and understand where they came from. All right. Oh, I put it here. There we go. And this is what happened. All right. So let's look at Tesla. Clearly from the price, this was a while ago, but Tesla, I cannot remember when I took this screenshot. I wish I could give you the exact time. But Tesla, the day before earnings was 222.13. The closest at the money options, this must have been very close to the split because they have 50 cents on the strike prices, was 10.04 and $10. Makes sense that the long call was a little more expensive because it's closer to the money. Now, and yes, when you hear on the media, this is exactly how it's derived. You are correct. This is the exact method. So this one was $20.04 altogether, represent about a 9% move. So that's our implied move that we were expecting from Tesla when it reported its earnings. So let's see what we would do. So this is the famous Tom Sosnoff trade here on how to play earnings using a short condor. What you would do is you'd say, all right, so the options market is expecting a 9% move. If that's going to be a 9% move for the call side, so upwards, that's going to put me at 242.50. I'll get only 295 for that. I need to cap my risk here because having just a short call requires a level 5 option. It's unlimited risk potential. If it moves too far, you could be in really big trouble. So start with the bear call spread. This is my highest movement. We go to our lowest movement now is 9% below that 222, puts us at 202.50. That we're going to get $3.08. It's very interesting on the options market. Put premiums tend to be a little higher because you fall down the stairs and you climb up, I suppose. But people are more afraid, and that must be why, but they tend to be slightly higher for that reason. Same thing here. We're going to cap our loss potential if it goes too low at 183. And so collectively, this is where we need the stock to stay is range bound. When Tesla reports, we don't want Tesla to go any lower than 202. We don't want it to go any higher than 242. So that $20 move. So that's a big range. That is a $40 range that we need Tesla to stay in. And this is a great example of a high volatility stock. Only got $2.50 for that. 250 altogether. This is something where you could put more than one contract on. But what happened post earnings, this is a great example where it did almost exactly what the options market said. The next day, the day low, I believe they missed on this one, was 202. So it moved 906, $20.13, which means you were able to close. This was the exact price the next day at 96 cents. So here we go. So this is a profitable trade right here because it moved a little more than we thought it would. However, it stayed very close to our range. It just went a little bit 50 cents lower. That's okay. But we close this at a net debit. You wouldn't want to hang on to that because what the intent of this is 1 day of movement, right? This was 295 and this was 308. On earnings, there is extremely high implied volatility because implied volatility is the market's expectation of an expected movement in the underlying security. And when we expect a movement is in an underlying security is extremely high around earnings because we know it's going to move a lot. We just don't know which direction. So therefore, implied volatility crushes. That's what implied volatility crushes after earnings reports, meaning this is one day apart, not even 24 hours, as in this was just right before earnings and then right after. So even if you take market sessions, it's not even a full day. So the premiums went from 249 collectively to 98 cent or 96 cents collectively. So this is 5 cents, the 242, and the day before still $20 out of the money, 295. So that's a great example of volatility crush, and that's the intent of these. The intent of this type of earnings play is not looking at the sharp directional movement, looking at how options are super highly priced right before earnings, and then capitalizing on that implied volatility crush. But it's essential to have these wings, we call it, to cap your risk in case you're wrong, like the NVIDIA example. There was an implied move of 11%. It moved 11%, but expectations were way greater than anyone thought. So it actually moved 15%, and that could have put you in a little bit of a loss territory. But that's why you add these, is you cap there is only a limited amount of loss that you can have in these type of strategies because of the long options you're buying. You're mitigating your risk here. You're reducing your premium, but you're mitigating your risk. And that's the intent here. Make sense? But no, this did not lose money. You sold, oh, there we go. I had it on there. Your original credit was 249. You gained 153. You sold at 249. You bought to close at 96 cents. Difference of those two, 153. So you gained $153 total. This was a winning trade. All right, great. So here are some, how do you gauge the risk capping? We will talk about that in a moment. I can bring up the OptionsPlay tool. So when you are trading iron condors, here's the what and when setups and closing outs, expectations, tips and tricks. So when you're doing this trade, you are neutral on the security. You see that it's range bound, and you are expecting a decrease in volatility. Because volatility is high, we want to sell options, and when it goes down, we want to be able to buy it back. That is beneficial for us. So your trade, you sell a call at the resistance level because it's not going to go any higher than that resistance, and you sell a put at the support level, the range bound where you think it's going to be, and then you add defined risk. So the risk is if it does break through resistance, where is your stopping point there, and then add an equal part at the bottom, otherwise you get broken wing trades. So here's your example. With the same rules apply when we're selecting expirations. So when we're selling options and that's the driver, our rule of thumb is 45 days until expiration because all theta decay is not the same. Meaning it does not move linear, but when you get to 7 to 14 days, it starts falling off a cliff, all else equal. So that allows you adequate time to capitalize from that theta decay. Even if it's an earnings play, it's still something because theta is also represented. It's not just time, it is extrinsic value altogether, and implied volatility is a component of extrinsic value. And hopefully this all makes sense if you've ever attended the beginner sessions. It's all set up in a way where we bring even what is an option into these type of sessions. Setup and tips, like I said, 30 to 45 days until expiration. You can modify that as fit. You just want to make sure that you are allowing that 21 to 14 days. That's what we're looking for here. So you can experience that theta decay and help that benefit you. Strike prices, they're out of the money, about 0.2 delta. Your further out of the money is about 0.10. So 0.5 delta is normally an at the money option. So you're further out of the money. Those are just the recommended. Expert tip is IV percentile over 50. That's going to tell you, IV percentile will tell you if the option has a spiked IV. That's what it's for. It's on most of your brokerage trading platforms will have that. They may also have IV rank. Higher numbers over 50 is what you're looking for from percentile. We have it on the OptionsPlay platform when you put in the symbol. And then I like to call this the risk-free range and the cost here. So an example of what happens with risk capping, it's easier to understand with the round numbers, and that's why we teach this way. So if you're selling the put at 100 and you are also selling the call at 110, that's the where we want the security to stay to recognize our max profit. You're bringing in $10, but we had to buy some protection. That cost us 4 altogether. So net, our max profit is $6. If that means we've got a little bit though, if it moves $6 in either direction, that's what I like to call our risk-free range because we have two break-even points. So if it goes as high as 116, we're not actually at a loss there. And we're not at a loss here either because of the protection that we purchased. But if it starts going beyond our past 94 and 116, then we'll be at our max loss at that area. So therefore, not mitigates risk, but it's that risk-free range that you want to think about as well. When you close out, these are just the general rules: 75% of premium, take profit, loss at 100%, consider rolling at 14 to 21 days until expiration. That's because of the theta decay. All right. Oh, and that's an old slide. So let's get that off. All right. So that is going through the earnings plays and how to look at theta decay and trading earnings with short options, but also how it is utilized with long options. Personally, I like to take a directional bias because of all of the theta and the implied volatility that's there, but sometimes that's not necessarily the case. And I really think showing the famous Tom Sosnoff trade is very interesting because it does have high probabilities of being successful because of that range-bound move. But know when you're playing with earnings, I'm going to call that a play, that anything can absolutely happen. And with economic events can also make a change, which I find very interesting as well. If you look at, I believe it was NVIDIA's last report, it was actually rather flat, but that's because of due to the time that it was in the market, whereas when their Q4 tends to be really, really well. All right. So let me pull back up the chat. I'm happy to pull up OptionsPlay, but we'll go through some questions and let me know if there are any other questions you want answered or anything else you need clarification on. Please repeat how you arrived on the implied move percentage. Of course. So this one here is the at the money call and put. Actually, if there, we can even do another one. Who is reporting? Anybody good? Any earnings reporting soon that you guys want to look at? We'll just calculate one. Let's see. And while I'm waiting for that, because I know that's going to be a lot to go through, Carvana is okay. You can look at Carvana. CrowdStrike, fun one. CRM. Oh, been looking at that. Okay. Yeah, let me stop sharing. I'll pull that up so we can do something that's applicable to now. Share. All right, here we are. So we're going to look at, I saw CrowdStrike. Earnings March 5th. That's a little far. What else was in there? I said Carvana. Oh, that's happening right now. PM. That should have already gone through. Well, what's good is we'll look at the closing prices and see what happened. All right, so way I would do this is high implied volatility. We'll start with the straddle. I would just modify this, always put it on the midpoint. These are sell, so let's go ahead and buy. And you want the closest month until, or the closest expiration possible. So the closest expiration possible with this is tomorrow. It's going to, by default, you're going to have the best practices, not an analytical tool, but it's very easy to turn into an analytical tool. All you do is add these two together, which we do for you here, but we multiply it times 100. So you can just move the two zeros and see that this is 1068 is the expected move for Carvana. So I'm going to grab my phone, get a little calculator. So I'd say 1068 divided by the last price, which is 52.41. And that gives me, and times 100, that's a 20% move. That is a very, very high move. Very interesting. Okay, so let's see what happened. I'm gonna get a post quote for Carvana. Do I have this up anywhere? CRV or CVNA. Look at that. It is 63.80, up 21% right now. So we said a 20.37% move. It sure did that, which is so interesting when that happens. So hopefully that made sense. Look at that. So this is the reasons behind it. If you're buying this call that expires in one day, remember the markets, stocks, options included, are a factor of supply and demand. More buyers versus sellers in every aspect. So if there are a lot of buyers, it's going to inflate the premium. That's where that implied volatility is coming from. Everyone expects a move. Everybody wants a piece. Buyers were willing to pay $5.90 for it, and sellers also pushed up that premium. So since they're willing to pay this much for it, nothing in life is free. That's the expected move. So therefore, that's why we take the amount, 1068 altogether, and get the anticipated move from. And as you can see, it gets really close, even after hours with NVIDIA yesterday. So it's going to be different when the market opens. And that's the difficulty with this, because options don't trade after hours yet. Maybe that'll happen one day. Who knows? But they do not. But post yesterday, I remember looking at NVIDIA and it was right around 11%. Started at 9 and then it went to 11%. So it's a great way just to see which way or how much the stock's going to move. And there's other factors you can put in together to get your directional bias. Rashid wants to look at Pepsi. So thank you for that example, whoever did that. We did that on the fly. I think it worked out well. So Pepsi, let's give it a look. I am a weekly chart person, so I'm going to use a chart platform that's on my other computer and look at the range bound, or let's put this at 6 months at least. And make this a week. My other indicators. It looks like it's still gaining momentum, because the way I look at a trend, it is lower lows and higher highs. But even failure to make a higher high like it is here, that's still a direction, as in this is a higher high direction. So perhaps in a shorter time frame, this is definitely range bound, but the overall trend looks like it might be turning bullish, but I want other indicators rather than just eyeing it. No, mine say flat. Okay. Yeah, I've got resistance right at 172 and then support right at 166. So yes, I'd say that's definitely range bound. That is a huge resistance point around 172. More of a slight bullish bias, but still neutral in consolidation. So yeah, good flag there. All right. Any other stocks we would like to look at? You can also, the way OptionsPlay does it too, is this is a proprietary calculator here that will show the 1 month trend and then the 6 month trend. Normally the 1 month trend is going to flip before the 6 month. So you see how this one will move around quite a bit before this, but we also put it here. So the yellow indicates neutral, 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 neutral. All right. Path, XOM, SQ. Someone gave CRM earlier too. Someone say Workday? Oh, that was okay. Dominoes. Let's see. PayPal. I'm gonna choose PayPal actually. Purely for selfish reasons. So their earnings are May 8th, so nothing coming up there. Full analysis we won't be doing on this one. If there's any earnings ones where we want to look at, we can do that and look at the implied move. WDY, is that workdays? WDay. Okay. They're February 26th. That is close enough. So do the same thing here to plot the implied move. This is where I would look at the 85%. Very interesting here because the earnings is February 26th and it's the 22nd today. But just modify, change it to the mid, and then put the expiration date as early as possible. 305. Is there a 306? There is not. Those are about the same. Okay. We don't have an exact. So this is where you got to do a little math, unfortunately. But if you want to know how to do it, I am happy to explain it. I don't have Gamma in front of me. All right. So we'll use the 85% rule here because it's not going to be exact, meaning this long option is, or the call portion is a little bit in the money. So it's inflated. And that's where that 85% rule would make sense, especially if there's a little more time and it's not exactly the next day. But 445 is the implied move here. So, which it moved a lot more today even, which is interesting. But 445, divide that by 306.62, and you get about, not a huge move, a 1.45% move. And that would be because of the expiration I chose. I'm really surprised nobody called that out. It did not include the earnings. So you have to make sure that it includes the earnings in there. This is going to have an extra 4 days. So let's do that again. I thought that was quite odd. So 70 of that, 2738. So we'll do 27.38 divided by 306.62. And that looks more accurate at an 8.9% move. So Workday is expecting, the options are implying an 8.9% move because it's a little far out. That might be where it would do the 85%. So that means take 2738 and I would multiply it by 0.85 to get 85% of the number. So now I'm 2327, and then I'll take 2327 and divide it by 306.62, and that gives me 7.5%. Which had already moved today, but that's what the options are implying for the earnings move for Workday. All right. Which one are we looking at? Look at Cisco, please. All right, we'll do this last one. And the IV rank on this is very high. So remember earlier when I said over 50, the way that IV rank works is 50 is going to be, it's for the last 30 days, what implied volatility has been for this specific security, because each security has their own implied volatility. 100 is super, super high. It's saying over the last 30 days, the implied volatility of the options are the highest they've ever been. So that's right now. That would be a good candidate because it's expecting probably a huge volatility crush. But we haven't done the directional bias or looked into anything like that. So that's where we haven't done our full due diligence. So me saying That's good. That's good from an implied volatility perspective. We've calculated the implied move. I haven't done my due diligence to give this a directional bias in the slightest. So please know that. Um, where are we? Do say Cisco? So they're May 15th. That's a far, far away. eBay. Do an iron condor based on earnings. We can on these, we do it on the Cisco ones if you want. So we calculated, it's still on my calculator. I'll do it again. A 7.59% move. Let me go back to the, oh, I have to modify again. Sorry, we were looking at Carvana. So let me put this back into the March. I think I froze my computer. Oh, I'm doing the strikes. Oh my goodness. All right, 52. And we want this one. So we're looking at, change it to the mid. 1235. Carvana just reported? Right, we did that. I'm sorry. All right, so we are very, very well over, and all my distractions are coming in. So I will call it a day, but thank you everyone for joining the session. Next week, we're going to do a session. I think I've only done it once before with OptionsPlay, where we're going, and it was requested when we asked for what your topics that you're looking for. But we are going to look at your portfolio beta and how to actually hedge and calculate notional value for your overall portfolio. So someone asked for that. How can I hedge my portfolio using index options? So we'll look at different index options tomorrow. We'll look at the S&P, or excuse me, next week, the S&P 500, the NASDAQ 100. We'll look at all of this. But any questions or anything else that you want, let us know. Thank you for bearing with me. We went through that, and I hope everyone has a wonderful evening, and I'll see you next week. Thank you so much.